Hey, good morning, everybody. Let's go ahead and get started really quick. I had a great question on Friday that I wanted to go over, but it also brings up the fact that I want to make sure that I cover my process with debit spreads and or butterflies or any kind of spread. So the idea on a lot of these during earnings season, I stay really busy trying the methodology of identifying supply and demand and then creating a debit spread structured around that supply and demand. And the idea is that one of these would go in the money. And when I price these out, I'm just going to give you a hypothetical. Let's say that this one costs $2, and let's say this one over here cost $2 as well. But the reward on one of these, if they were to go in the money, let's say it was $500. Okay. So we paid a total of $400, but there is the um, chance that I could make $100 on this trade. Now, why would I even do something like this for $100 for, let's say, in this case, one contract on both sides? Well, because the story, if you remember, is that instead of getting FOMOed into a earnings trade or the idea of not taking an earnings trade, can be done with supply and demand. And instead of spending, say in this case, $20 to be at the money and, $20 over here to be in the money, I am reducing my cost by doing debit spreads. Now, what happens in the alert section, okay? If for some reason, there's different scenarios here. Let's say that these guys have earnings and they go completely sideways. That means the premium is burned on both sides of this trade. And in this case, most likely the trade is going to yield nothing. Okay. Now, what happens though is after the earnings report for something like this, I'm going to buy back the short side. Okay. So that's what you see come through the alerts. And what happens is, let's say that this 8 by 830 is something that you see when you first bought it, but after the earnings, they lose so much premium. Let's say that they're bidding and asking between zero point 0.2, right? And I don't know, zero point 0.3. All right, so these have lost complete value. Now, am I losing $800? No, of course not. Remember, I'm only paying from the get-go the difference between the spread. I would never do something like that. All right. So what happens though is that these long positions are now basically pennies because they didn't do well. And then the idea is that once the earnings is over, and price finds either buyers or sellers, these that are looking like pennies could turn into dollars. Now, in the back of my head, in this scenario, I understand that I paid $4. And let's just say that in this case, Ulta calls, right, were basically 20.20 by zero point 0.3, 20 to $30 here. Let's just say they got in the money and we still had 3 days left. And all of a sudden, these calls are actually going for $14. Okay. So I paid four for them. And in this case, I'd make $1,000 on this trade. All right. So that's how I'm keeping track. Now, when you break a debit spread in Thinkorswim or probably in any platform, the percentages are not going to show up. It's too complicated. Okay. Now, if I go in the money, this is where you will see alerts go off in the room when I sell a debit spread. Let's say we had several, right, last week, like for example, SMCI, I think the highest was like 266%. That means that this spread did really well. And in that case, I would sell this spread, but then I would come over here since SMCI was not going down, I would buy back the short side. Okay, now the trade is already profitable. It does not matter the percentage on this side. What I'm looking for in this case is that anything over $5 or $10 is just a credit to me, if you will, once I sell it. Okay, because in this scenario, what I'm looking for is that one of the supplier demand zones is hit and then I'm going to profit more than I paid on the whole thing. Okay, this is really important to understand. And the only way in this case I'm going to lose money is if I mismanage, all right, or we just completely go sideways. Okay. An example would be last week. All right. We played V. And the put side did really, really well. All right. So I just want to show you, and these are not the same numbers or anything like that. But basically, what we did was we came over here and we bought, say, the 270s. All right. And then we sold the 265. And over here, we bought, actually, we did a butterfly on the put side. All right. And so it looks something like this. All right. And then we had a call debit on this side. And let's just say that it was, I don't know, the 280 by 285. Okay. So the trade looked like this when I first put it on. What happened was V actually went in the money and was like this perfect trade to the downside. So I sold this trade for profits. It's all gone. And then I come over here very quickly and I sell the short side over here because V was down, and that means the calls lost all of their premium. Now, the overall trade ended up making a couple dollars, but could have made me a lot more. For example, when I sent out the alert and said, hey guys, we're pretty much in the money now, that call was actually going somewhere between $1.75 and $2. And because I already knew that I had made enough money to cover both sides, I did not manage the trade. Okay. My idea was the market was bullish and that V would continue to move up. And I was looking forward to maybe being deep in the money by the end of the week. And it just didn't work out that well. Okay. So it could be looked at as possibly mismanaged, if you will, because I could have taken the $200 here plus what I made over here, and it would have been really a nice return. Instead, I relied on the fact that I already knew that I made enough money from the put side, right? And then over here, I was, I should have like just taken the money off, but again, shoulda, woulda, coulda. Either way, I just want to make sure that I'm really clear on the idea of managing the trade. Now, as far as the alerts go, so the question was, how do we know, if it was overall profitable? Again, we have a bot that reads the API, and it's only sending you the information that is in Thinkorswim. So when I break a debit spread, let's just say that we made money over here on the call side, all right, and let's say that we had a put, and let's just say it was the 270s. All right, and we had sold the 265s, but price went up, so we sold this for profits over here. Okay, boom, we make profits. Then I come over here and I buy back the short side. It's not going to register a percentage because I'm only left with this, and I didn't buy this straight up in the first place. It'd be different if I only bought a put, all right? And let's say I bought that put for $1. It would be different if I had only bought a put and now it's trading at 30 cents, then obviously I would have lost 70%, right? But it's not doing that. When we put these on together, it's lumping them together. So there's no way for my bot to say whether or not this is a gain. And to be fair, guys, to be fair, I don't care if it's a gain if these over here did really well. Do you see what I'm saying? What I'm looking for is for one side to take care of both sides. That's the idea of my entire strategy when it comes to earnings. All right. The most money that I can lose is what I paid for both of them. So in this case, if we paid two over here and I paid two over here and it goes completely sideways, nothing goes in the money, nothing works out, I could lose $4. That's why a lot of times, though, you'll see that I make these really inexpensive and I look at them as like one trade, right? I'm looking at the overall amount that I put on both sides and if I can end up making money for both sides. Okay. So last week, off the top of my head, Microsoft, it was in the money 68% on the put side. And then the calls I ended up selling for 60 cents. That was a negative trade. The reason why it was negative is because I wasn't here to manage the put side when it was up 70%. And most likely, if I would have taken that 70%, then sold the call side, I would have done great. In summary, there's just no way that I can relate the bot. Like the bot's not going to put out this information after it's broken, whether or not the overall trade was profitable or not. So that leaves us to two things. You can ask at the on Friday. So say of expiration, you could say, "Hey, did that trade end up being profitable or not?" And I'm more than happy to tell you yes or no. And then the second thing would be if you took the trade and you managed it, I think those are the people that are probably not asking questions because they know whether or not it worked out or not. It's really that straightforward. If you guys have any other questions, just let me know. Have a great day.